if you compared the doctor mortgage to the conventional, which is, the broad category on the right, the doctor on the left, the down payment can be as little as 0% for some banks. You typically don't have the private mortgage insurance. It typically is a higher interest rate for the doctor mortgage, and the FICO minimum tends to be higher. This depends on the lender, but it can be higher for the doctor mortgage. So I'll pause there for a breath, have the expert Daryl weigh in, correct me if I made any mistakes.
No, it looked great, Michael, and I think you've got it all right there. The doctor mortgage is a great loan. It doesn't require a down payment. In fact, our loan program at Premise allows up to $1 million without any money down. You still have to qualify from a credit score standpoint, and that's right, 720 middle score, and but the debt ratios have to still be in line to qualify. So that's something to factor in. But there is no mortgage insurance, so it's a great loan for doctors. You've earned it, but no money down up to $1 million, and there's no PMI. Yes, it's a slightly higher rate, as it should be. There's more risk involved, even though a doctor's career is going to be more stable and the income is going to increase. But with no down payment, there is a level of risk there, especially without the mortgage insurance. The conventional, for someone who does have money to put down, if you're a first-time home buyer, you can put as little as 3% down. If you have owned a home before, you'll have to put at least 5% down, unless you go with that government loan like you did, Michael, where 3.5%, and that's eligible for anybody if you bought a home or not. And the conventional rates are a little bit better than the doctor, a little bit more lenient from a credit score standpoint, but you have to have money to put down.
Gotcha.
One more thing on the doctor mortgage, Michael, I didn't mention, even though there's no down payment requirement, you do have to factor in that you have to have money to close those closing costs you mentioned at the beginning of the program. So you have to have money saved up to pay the closing costs at closing, and you have to have money in reserve, whether it's checking or savings or retirement. Typically, that's 3 months of a mortgage payment. So if your payment is $3,000 a month, you need to have $9,000 in reserve on top of the cash you'll need for closing costs. So no money down, but you still have to have money set aside.